Well, hello everyone. This is week 7 of the massive open online course for the University of Nicosia's master's degree in digital currencies, and I'm Andreas, I'm Antonopoulos, your teacher. My apologies for the rescheduling. I wasn't doing so well on Thursday, so we had to move it, but I see many of you were able to make it today, and I've got some great questions to answer. If you have additional questions, feel free to drop them in the chat. I won't be commenting on comparisons of different altcoins or investment advice, of course, because that's not what we're here to do. But this week we're talking about different types of tokens, blockchains, currencies, and altcoins, and let's dive in straight to your questions. Our first question comes from Francisco. Francisco asks, what's the fundamental difference between cryptocurrencies and tokens? Well, Francisco, there really isn't a clear-cut definition of these things. There's no authority that can tell us what these words mean. But out of popular use, I can draw some distinctions that help me differentiate when I use these terms and how I use these terms in conversation. Generally speaking, the concept of a token is any abstraction that represents something else that doesn't have intrinsically the value of that thing. So we often use it to mean valueless things, like a token that you use to play a game or something like that. In our industry, of course, that's not what it means necessarily. Tokens are things that represent a variety of tangible or intangible goods that are connected to a blockchain. I would say that in some sense a cryptocurrency is a subset of a token, meaning that a cryptocurrency is a token that represents a monetary instrument, a currency. So Bitcoin is a currency token, a cryptocurrency that represents a unit of Bitcoin, some value of Bitcoin. Ether is a cryptocurrency that is a token used for gas in the Ethereum system, and it represents a certain value of that currency. So that's one way to look at it. Strictly speaking, cryptocurrencies are tokens. But often in our industry, another distinction is made between the two. And that distinction is cryptocurrencies are mostly the things we call the base token of a blockchain. Meaning that on Ethereum, the token that we use on the base blockchain is called Ether, and that is a cryptocurrency because it has its own chain. Pardon me. Microphone fell out of the pocket. So in our industry, we often use these terms slightly differently. We say, for example, cryptocurrency, what we mean is the currency that runs the blockchain itself. So a cryptocurrency has a chain. And we often use the term token to represent something that is on another chain. It's not the native token of the chain, but a token running on top of it. So for example, and we use this distinction even before the invention of Ethereum. We used it in Bitcoin when we had tokens running on top of secondary protocols like Omni and Counterparty and various other layers on top of Bitcoin, colored coins, for example. So a token would be something that runs in a blockchain, whereas a cryptocurrency is the monetary unit, also a token, but the monetary unit that runs the blockchain, the chain itself. So if there is a chain, then we'd call it a cryptocurrency if that is used to represent the currency unit of that chain. Whereas if it's living on another chain that has a native currency, we'd call it a token. ERC20 tokens, of course, are tokens. Non-fungible tokens, of course, are tokens. And many of the other platforms that allow you to create tokens on top, we call those tokens. And we call cryptocurrencies the ones that have their own chain. Again, these are fuzzy definitions. There's no clear distinction between these things, but that's how I've heard them commonly used and how I try to use these terms to avoid too much ambiguity. All right, let's see what we have next. Our next question comes from Pierre. Why and how are almost all of the coin's tokens so highly correlated to Bitcoin? Thank you for sharing your knowledge. Thank you so much, Pierre. Good question. So I wouldn't say that all of the coins and tokens are highly correlated to Bitcoin. Some of them are actually counter-correlated. And we see that occasionally with deviations. For example, we've often seen deviations from coins that are attempting to compete with Bitcoin or have such radically different conceptions of what a cryptocurrency is. XRP versus Bitcoin might be a good example. XRP is often counter-correlated with Bitcoin. But you are correct that if you look at the broader market, when there is a bull run, the bull run usually starts with Bitcoin and then it overflows into other altcoins. Why is that? Well, the primary reason is that Bitcoin's establishment as the first broadly known cryptocurrency and the longest running blockchain means that it is the most well-known brand and it has the highest value and dominates the market in terms of market capitalization, liquidity, availability on exchanges, etc. It also acts as almost the reserve currency or on-ramp into the rest of the crypto sphere. So if you look at trading pairs, for example, while there are, of course, trading pairs like BTC USD and BTC Euro and BTC Yen and BTC almost everything. If you look at other cryptocurrencies or tokens, often they do not have trading pairs versus a national currency. They might have one vis-a-vis the US dollar, but they might not have one vis-a-vis the euro. They might not have one vis-a-vis any of the other 194 national currencies, which means that if you hold that national currency and you want to get into an altcoin for whatever reason, you would first have to convert it into Bitcoin, and then there is a Bitcoin to that other cryptocurrency trading pair. And what that means is that forces everything through the funnel of Bitcoin. So one of the reasons that you see this correlation is because Bitcoin acts as the reserve currency and the liquidity source for all of the other cryptocurrencies. There are a few exceptions. Ethereum nowadays has its own on-ramps for many national currencies, and that is true really of the maybe top 5 cryptocurrencies. But even those, at first, only had Bitcoin trading pairs. At first, there was only one. So this legacy creates that momentum. And if you always enter via liquidity on Bitcoin, then that means that the market correlates very, very strongly. Another reason is sentiment. When a bull run starts or when the opposite, a bear market emerges, what happens is people will initially get excited about buying Bitcoin. At some point, they reach a level of price where they start getting uncomfortable and they're like, maybe it's overpriced. There's another element which is psychological known as unit bias, meaning that people consider owning a single unit of the currency as some achievement, regardless of market capitalization or price, or the divisibility of the system. So they're like, well, I can't buy one Bitcoin because it's so expensive. Of course, you can buy a tenth, a hundredth, a thousandth, a 10,000th, a 100,000th of a Bitcoin, and that's much more affordable. You can buy $1 worth of Bitcoin if you want, or even less in many, many places. But people make this psychological association. So when they see the unit as being expensive, regardless of market capitalization, they often then look elsewhere. They assume that means that the valuation is likely to top out. So they start moving into altcoins. Now, a lot of people will say that's diversification, but based on your question alone, you can see that that's not actually the case. As we have already described, these things are highly correlated. So it's not diversification to remain in the same asset class in highly correlated assets. What it is yield chasing. It's chasing higher returns by introducing much, much higher risk in what is already a risky asset. And then this also happens in the corresponding bear market. So first, Bitcoin fills up, then it overflows into the altcoins, and then if Bitcoin starts dropping, it sucks liquidity from everything else and then back into Bitcoin. It becomes a safe haven exit, and then eventually people exit into stablecoins or national currencies. So we see these cycles work that way. Now, it's important to understand these things because the market dynamics behind these cryptocurrencies, regardless of whether you're an investor or you're looking at it purely from a technology perspective, you need to understand how these things are traded. This has nothing to do with the underlying technology, and that's because the vast majority of the market activity you see has nothing to do with underlying fundamentals, and it's almost entirely based on sentiment and price reflexivity, meaning that the price goes up because previously the price went up, and people are chasing a number. Yes, the flowers are back. Yes, turns out these are real. You know, they die. So I have to get new ones. And if I haven't been able to visit the supermarket, which I tried to avoid because of the pandemic, I don't have fresh flowers, and I don't want to put, you know, half falling apart flowers in the background because then that would look sad. But these are nice. They're fresh, relatively. And they're back, yes. Daniel asks, might some Bitcoin be worthless in the future? Do you think it's crucial for Bitcoin to implement innovative privacy technologies like Mimblewimble, so that Bitcoin, which have a bad transaction history, will have the same value than untainted ones in the future? I'm asking because right now Bitcoin is not anonymous, and I'm wondering if, say, I want to buy something on Amazon, try to pay with Bitcoin in the future, and it might be possible that they block my payment because I own Bitcoin which had been used in criminal activities previously. This is a great question, Daniel. This is basically a concept in currencies called fungibility. So if you haven't heard that term, it's important to understand. Fungibility is the ability to have a currency where you cannot distinguish one currency unit from another. And Bitcoin does not have fungibility. You can create some degree of fungibility by breaking statistical correlation through techniques like coin joins and coin swaps and pay joins and various other privacy protecting technologies, where basically you remix coins in a transaction to break the correlation. Ultimately, however, even if there is a very, very complicated and untangleable history, there is still a history. Here's the thing though. We haven't seen this cause Bitcoin to be worthless. We do see occasionally that some tainted coins become not tradable on exchanges. And in that case, usually what happens is the exchanges will send them back because they don't want to touch them. They occasionally freeze them, but not often. And they don't want to hold on to these tainted coins because they will cause problems for their trading as well. So what happens is we do see occasionally if coins have been tainted by certain privacy technologies or criminal activity that it's difficult to use them on exchanges. However, that does not mean that they cannot be traded. They can be traded on cash markets, on decentralized exchanges. They can be used to buy things from vendors. They can be used in a variety of areas where there are no money transmission regulations. So the exchanges are bound by regulations to check the origin and destinations of certain coins because they're bound by national jurisdictions. But if you're trading with other people, you do not have an obligation to verify the source of funds. That is not a legal requirement in almost any country that I know of. It's also not a legal requirement if you're a merchant selling things like, say, Amazon, to track and trace payments from where they come. Who knows what will happen as we see larger and larger merchants get into this space. But certainly on decentralized exchanges, over-the-counter trading, cash trading, and smaller merchants, this is not an issue. The merchant will accept your payment. As a result, we don't see a discrepancy between the value or exchange rate of tainted and untainted coins. Nobody's selling Bitcoin at a discount because it's tainted, and nobody's paying a premium. Although we have heard a rumor many times that people will pay a premium for mined coins. Anytime I've asked a miner about this, or someone who talks to miners or works with miners a lot, or any of the exchanges, I have not heard anyone tell me that miners can actually get a premium on the market price of Bitcoin for Coinbase pristine virgin Bitcoin that hasn't been touched. So really, how realistic is this? I don't think it's a problem. It certainly won't be worthless. Even if there was a small discount, I don't think it would be worthless. And there's a practical limit to how much tainting companies can do. And how effective that tainting is. So they'll do this, and we call this security theater. And let's call it what it is in this context is compliance theater. And compliance theater is where they check what the law says, and they comply with the law, and they do things to demonstrate that they're complying with the law, but ultimately they don't care. They don't want to stop their customers from spending their money. So they will do the minimum necessary to achieve the letter of the regulation. Let me give you an example. Let's say that the regulation says you have to check the origins of transactions. Great. How far back do you check them? How far back do you check them for taint? And this is a metric that is very important in this type of analysis. So let's measure it in terms of hops. Let's say each transaction is a hop. So if it was tainted one transaction previously, maybe you stop that. What about 2? What about 3? What about 4? What about 5? So if you keep going back, you have the following problem. These are not linear systems, they're trees, meaning that if you go back, coins may be coming from multiple transactions, so you end up exploring a tree of coins. It's not a single history line. It's a tree. In fact, it's a graph because coins both spread out and they merge together, and they spread out and they merge together, which means that the more hops back you go, the more the complexity of your graph expands. So from the analysis perspective, it becomes very difficult to explore that graph. But from the user perspective, it becomes very easy to expand that graph, to create transactions that spread and merge and spread and merge and spread and spread and merge and spread the coins out and create distance in your own wallet. So if it's tainted 3 transactions back, I make another transaction to myself, and now it's 4 transactions back. I make 10 more transactions, and now it's 14 transactions. How much does that cost me? Well, depends on the fee I'm willing to pay. Maybe I lowball the fee and wait for a time when the network has low capacity. Maybe I put it in a Lightning Network channel and then get it out in a different channel. Yes, as you can see, it is fairly simple to evade these types of regulations, which means that, and of course the merchants and the exchanges know this, So they're not going to go looking 100 hops back where every coin is tainted and basically shut down their entire system. They're going to do the minimum necessary that the regulators require, and they're going to scream if the regulators require them to do unreasonable things. Meanwhile, you can do things very easily to get around this silliness. So ultimately, we don't need strong anonymity in order to avoid fungibility problems in Bitcoin. There's a relevant question here from Daniel again, which has to do with privacy coins. Now, privacy coins are a very interesting topic. Privacy coins are a whole category of coins that have a very, very unique and clear differentiation of purpose. And that's why I have a very big interest in privacy coins, and I study them in addition to Bitcoin. So, for example, Monero and Zcash, which are probably two of the strongest privacy coins, but also Grin. I look at these and I'm interested in their development because what they do is they pioneer privacy technologies, which may or may not be adoptable by Bitcoin. But regardless, their very existence gives the entire space better tools, but also better political arguments. So let's go to the question, you'll see what I mean. Daniel gets this. Daniel asks, since the darknet giant White House market has proclaimed to drop Bitcoin and started to accept only Monero, XMR, do you think that privacy coins whitewash Bitcoin's formerly seen image as a currency that is used by criminals? I'm just asking because I hear and read it so often that some people say that Bitcoin is primarily used by criminals, and now we see that more and more darknet marketplaces switch to privacy coins. So there are two aspects to this, Daniel, and this is a great question. The first aspect is that the argument that Bitcoin is primarily used by criminals was never true. It has always been a propaganda talking point that is not backed by any of the evidence, and there has never been backed by any of the evidence. The idea that currency is used by criminals is a simple truism. Currency is used by criminals just like every other modern convenience is used by criminals and every other modern technology is used by criminals. There is no currency that is not used by criminals. Every currency is used by criminals and you can't stop them. Criminals use the banking system to launder hundreds of billions of dollars a year, and that's in a highly regulated environment. So do criminals use Bitcoin? Of course they do, just like they use everything else. But it's never been primarily or even significantly used by criminals. Its significant use has been outside of criminal activity since the very beginning. It's been used by geeks. That's a more true statement. It's been used by techno enthusiasts. That's a true statement. It's used by people in developing countries to escape poverty, to overcome difficulties with international money transfers. It's used by businesses to do cross-border transactions, and it's used a lot by investors for speculative purposes. All of these things are true statements, much more than the idea that it's primarily used by criminals. So that's propaganda. But then again, propaganda can be fought with counter-propaganda. And of course, it becomes harder and harder to argue that Bitcoin is used by criminals when Bitcoin is avoided by dark markets because of the fungibility issues we just discussed. Bitcoin doesn't have fungibility, it doesn't have strong anonymity, it doesn't have strong privacy, and that creates a very dangerous environment in dark markets. It's important to make a clear statement here. Darknet markets are not criminal markets. Darknet market use is not criminal use. There may be some things that are criminal to buy or own or sell in some jurisdictions. But there is no universal law, and there is no universally criminal things. So, well, okay, maybe there are some universally criminal things that exist on darknet markets, but for the most part, the vast majority of things that are sold on darknet markets may be illegal in one jurisdiction, but they're not illegal in many other jurisdictions. So it is also propaganda to say that darknet markets are markets that facilitate purely illegal activities. People were buying socks and keychains on the Silk Road when it first started, just as much as they were buying Bitcoin memorabilia and stickers, as well as drugs. But even some of those drugs are legal in many jurisdictions. Again, this is a gray area. So it's important to not make absolute statements for propaganda purposes. So anyway, this is a complicated issue, and it's an issue fraught with political undertones. But the bottom line is that it becomes harder and harder to make these absolute statements that were never backed by facts, when those facts get shakier and shakier with each iteration. I would like to see stronger privacy in Bitcoin, not because I want to use it for illegal activities, but because I believe privacy is a fundamental human right, and the ability to do universal surveillance of innocent people is fascist, and I don't want to see that in finance. All right, let me take a quick break, see how we're doing on the chat, if there are any follow-up questions, and then we'll go into some other topics. All right. I hope everyone's having fun so far. Our next question comes from Lembit. What are your thoughts on Filecoin? So I won't comment specifically on Filecoin because I generally don't make comparisons or comments about specific tokens or projects other than the ones that I'm very familiar with from a technical perspective. I study some systems in depth, and when I have studied them in depth, like, you know, written a 400-page book or something like that, then I can express an informed opinion about them. I cannot express an informed opinion about things I haven't studied. So I'm not evading here, but I'm going to answer the question in a more broad way, just to be intellectually honest. I think that's important. Filecoin, from what I know, is a token that enables storage sharing. And I believe it uses a proof of storage system as its consensus algorithm and backs the IPFS system. Now, I believe that there is a very, very interesting application space for the broader category of resource-based or resource-sharing tokens. And that means tokens that allow people to share resources that they own, to lease them out. And this is basically the Airbnb model of computing, right? So what Airbnb did for housing, to take underutilized assets and then share them in a way that increases their utilization and delivers economic advantages to the owners so they can essentially amortize their cost of ownership, and by making that resource available. So if you think about it, your hard drive is usually, or should be, 50% empty, because you bought one big enough to fit all your things and you don't want it to be full the first year you buy your laptop, so you buy a bigger one than you need at first, and usually underestimate how big it needs to be. I usually get the biggest one I can, and then it's empty. Right now, I think probably 50% of my hard drive on this laptop is empty. And that's not a small amount. That's like 250 gig at least. No, actually, I have a terabyte here. It's about 500 gig. on this drive. And I have a whole bunch of other drives. I mean, I do video production, so hard drives are a very big resource I use. So why should all of that be empty? Same thing for my bandwidth. My bandwidth most of the time is underutilized. Same thing for my CPU. My CPUs are not running 100% all of the time. My GPUs are not running 100% all of the time. So all of these computing resources that I have, why are they so underutilized? Well, because I cannot monetize them in a way that preserves my privacy, that doesn't violate the terms and conditions of any service provider that I'm using, that is convenient, easy, and doesn't interfere with my work. And so being able to monetize these underutilized resources is a very clear application, and an application where blockchain can help. It combines, the fundamental principles of blockchains, being able to achieve decentralization of these resources, so having storage in multiple locations, enabling uncensorability of the applications that run on top of these. The thing about sharing storage is not just about me making money off my hard drive. It's also importantly about me being able to back up my hard drive to other computers around the world in an encrypted way so that I don't lose any of my privacy, but also in an incredibly resilient and censorship-resistant way where it's impossible to erase that data because it is in multiple places that are geographically distributed and under the control of diverse owners. So that gives me uncensorability for my data. That also means that I have the ability to access computing facilities even if, for some reason, I'm being prevented of doing so in my current location. And again, that gives me geographic decentralization. It also means that I can build applications that are effectively uncensorable. This concept is more broadly described as Web 3.0. The decentralized or the re-decentralized web. And so I see technologies like this that allow you to share CPU, GPU, bandwidth, Wi-Fi, radio capacity, hard drive, network facilities or capabilities, node infrastructure like Bitcoin nodes and Lightning nodes and Ethereum nodes and the facilities they provide, and the ability to make micropayments that allow you to consume those resources, and other APIs. A very, very useful application space that not only benefits the owners of those resources who can monetize them and depreciate their capital costs, but it also benefits the broader world because it gives us massively decentralized, uncensorable applications built on top of these broadly distributed computing resources. All right, let's see what else we have. Nick asks, do the ETH2 upgrades and the move to proof of stake make Ethereum potentially more secure than Bitcoin? Is that a threat to Bitcoin as the premier cryptocurrency? So this is where I break my rule about comparing different systems, because in this particular case, these are two systems that I study and know very, very well. So do the Ethereum 2 upgrades and move to proof of stake make Ethereum potentially more secure than Bitcoin? I think not. And the reason is that while these upgrades will help Ethereum achieve its primary function as a platform for smart contracts, that primary function requires certain compromises in the speed of development and iterations that occur in the system, meaning that Ethereum has to move fast and iterate fast because it is a Turing-complete platform with much, much greater complexity. Complexity is the enemy of security, and the way to mature a complex system is through rapid iteration, which is the exact opposite development culture of Bitcoin. Bitcoin is secure by having a conservative development culture, keeping things excruciatingly simple and single-focused, and that serves it very well and makes it very robust, very secure. In order for Ethereum to change its fundamental development culture, it would undermine its primary purpose. And the same thing applies to Bitcoin. So, no, the Ethereum upgrades make Ethereum better. And the move to proof of stake allows Ethereum to improve its scalability and also to improve its fee management, because at the moment, Ethereum is running into some very serious fee problems with high volatility of fees. And we're going to see a couple of other things like EIP 1559 to address that, sharding and optimistic rollups and all of the other technologies that are being rolled out prior to ETH2 and as part of ETH2. But all of these rollups are intended to make Ethereum more scalable, more flexible, and faster moving, not more secure. The security model continues to be the same, and that is a security model that is geared towards rapid iteration and improvement, and not the preservation of features and capabilities in a conservative mindset. I don't see any of this as a threat to Bitcoin as the premier cryptocurrency, because the goal of Bitcoin is fundamentally different to the goal of Ethereum. As I've said many times before, and you can watch a talk of mine, I actually tweeted about it today, Bitcoin is the next Bitcoin, for exactly the same reasons that Ethereum is the next Ethereum. So there are a bunch of other questions that I did not address today that were, does X threaten Ethereum? Does Y threaten Ethereum's dominance as the smart contract platform? And the answer is very much the same. When something has dominated an application use space and acquired a massive number of developers and libraries and development practices and all of that, it becomes a Schelling point. It becomes a force of attraction for more developers and more analysis and more libraries and more everything, more liquidity. It is very, very difficult to unseat the market leader in a specific category without doing something that differentiates massively or improves massively, not just a bit, an order of magnitude improvement. And it is difficult to find an order of magnitude improvement that the leader can't adopt, or that doesn't differentiate so radically as to shift you into an entirely different application space, or that involves trade-offs. That's exactly why the market leaders in each category remain the market leaders until there is an upheaval of the entire market, which is extremely unlikely at this stage of development when things are moving so fast. These systems can absorb changes that are useful, and the changes they can't absorb, they usually can't absorb because they involve trade-offs that differentiate too much. So if you want to see more on that, there's a video I did called Bitcoin is the Next Bitcoin, which also talks about Ethereum and other market leaders in a similar vein. All right, I'm going to address a quick mention on the chat. Kilatoro said, I think to give someone HD space, hard disk space, is dangerous from a legal point of view. Without checking what the files contain, it exposes a hard drive owner to legal liability for violent content, sexually abusive content, etc., etc. A clarification that will help you understand how this works. When you give disk space to a network like this, when you share resources like disk space with others, and there's a reason why disk space is done first, because it's the simplest to do, you store encrypted blocks of data that not only do you have no idea what they contain, they're not files, they're not complete files, they're just blocks. And you may not have a complete file from any one source, you just have blocks of data. These blocks of data are not complete, and they're also encrypted. So there is no way to know what they contain, and only the owner who has the encryption keys can actually turn them back into files. All you're storing is randomized bits, which by definition cannot contain illegal content. So there is no liability issue with storing encrypted blocks and making those available, especially since you're not making them available to the original owner. These are being constantly distributed around the network, and the owner can retrieve them from anywhere that they have been distributed. So this is a common topic that's come up from the very birth of these types of services. This is not like the early days of Napster, where you were sharing a specific song or something like that. We're talking about blobs of encrypted storage. It is no more a liability than it is a liability for Google to store, or Dropbox to store, an encrypted blob of data on their cloud services, which of course they do. All right, the next topic, which might be one of the last topics we cover, is going to be non-fungible tokens. Non-fungible tokens are an interesting topic. I jokingly say that NFT stands for Naming Failure Total, because it is what I like to call a negative explanation, meaning that if I tell you NFT means non-fungible tokens, I haven't explained NFT. I've now created two questions where previously you only had one. You asked me, what does NFT mean? And instead of answering that, now you ask me, what does fungible mean? So it's not a good explanation, because you have to first explain fungible. Fortunately, I just explained fungible in a previous question, which had to do with fungibility of currency. Same thing. The best way to understand non-fungible tokens is to think of them as deeds that show ownership of a tangible or intangible asset that is either on the blockchain or in the real world. So they're basically titles of ownership, just like your car registration document or the deed to your house. So Linda asks, where do you think NFTs will settle into the crypto ecosystem, given the recent craziness of the past month? Does this actually boost ERC 777 tokens and Ethereum overall? This is a very, okay, I can't really answer the question from a financial perspective. I think it's safe to say that the crazy valuations we've seen for NFTs in the past few months, especially in the past month, are probably not going to be indicative of the long-term trends. But that's speculation. That's not something I can back with facts. We may be looking at a complete realignment of the art market that is going to transform the way art is being managed. NFTs are not just art, of course, and they're certainly not just digital art. And they could represent a whole bunch of other things that are very interesting, and ownership of other things, although digital art is the clearest example we have of the use case, at least for now. I think the interesting things about NFTs is the capabilities that they offer an artist or content creator to connect directly to their audience without the intermediation of a platform. When I issue an NFT for something, if I issue an NFT for something, it allows me to have a direct connection with my audience. And that means the audience can use that NFT to do things like gain access to perks or rewards or secret websites and chat rooms or things like that. They can use that NFT to prove ownership and show loyalty, or to show that they're a patron of my work. And that they support the work that I do. So there's a broader meaning to this. This is not just a speculative thing that you buy and sell. it's not just about the first sale. And I think it's very important to understand that, meaning that if I sell an NFT, unlike if I sell a book, my relationship with my audience does not end there. The NFT provides a continuous connection back to me as the content creator. And that is a unique capability. It is a programmable deed that can have other benefits that accrue to it, or can generate additional sources of income for the content creator after the initial sale. So there's a lot of more development that we can see in this space. Does this boost Ethereum overall? I think Ethereum has certainly demonstrated that it is the most suitable platform for this NFT phenomenon, which, if you were paying attention, you knew back in 2016. This is something that we discussed. I talked about NFTs in my book on Ethereum, and it's a clear and obvious use case for tokens. So I think it does demonstrate quite well the flexibility of Ethereum, and most importantly, I think what demonstrates that even better is the secondary applications that can be built by combining NFTs with other aspects of the Ethereum ecosystem. NFTs plus identity, NFTs plus governance, NFTs plus dividends, NFTs plus access tokens, etc., etc. So and decentralized exchanges, of course, and marketplaces. I think there's a lot more to explore here. So will NFTs settle into the crypto ecosystem? Yes, I think they're here to stay. Will they be at the current crazy valuations? Probably not. But the technology itself is incredibly innovative. As with previous waves of this technology space, you have to be able to differentiate between the possibility and innovation embedded in a new technology and the impact it's going to have on several adjacent industries or affected industries that it is disrupting or disintermediating, and the valuation of any one of the companies that are involved in that space and whether they're real or they're outright scams. Let me give you an example. ICOs, a revolutionary way to connect global investors from anywhere in the world to global startups from anywhere in the world and bring them together in a way that revolutionizes early stage capital raising, or a market full of scams, sharks, and pyramid schemes? And the answer is both. And you need to be able to understand that in order to really appreciate where these things are going. NFTs, a multifunctional programmable deed that can represent tangible or intangible things, revolutionize the arts and the contact between creators and their audience, and provide additional secondary benefits, markets, and access to audiences and creators in a way that changes the way we deliver creative content for the future. Or a completely overhyped speculative market with crazy valuations that bear no resemblance to the fundamentals that has become a massive FOMO. Both. All right, let's go to the next one. David asks, what stops me from copying a non-fungible artwork? This is a great question, and it comes up a lot with non-fungible tokens. David, nothing stops you from copying the image of that artwork, but you can't copy the non-fungible token, which means that the non-fungible token can only be owned by one owner who can demonstrate that they own the non-fungible token. Even if you make a digital copy, which may be an identical digital copy of the artwork, you still won't own the non-fungible token. So the non-fungible token becomes the thing you can't copy, that the actual owner can demonstrate, proves that they supported the artist, that they funded the work, that they value the work, so they can have that reflect on them, which is one of the reasons people consume art. Is because it allows them to associate with the artist. It is a status symbol. And the non-fungible token itself becomes a status symbol of being a patron of the arts. And I can give you a really simple example. Let's say you get one of these books at an event that I do, and I sign it inside, and you have a signed copy of the book that says, "To David, thank you so much for your support, Andreas," and you have this signed copy of the book. What stops your cousin, whose name is also David, from photocopying the entire book, perhaps with a perfect photocopier that produces color copies, binds it, and then it's almost indistinguishable from the book that you got signed? And it's signed to David. Well, they will always know that it's a copy, and you were the one that came to the event and got it signed by me, and that has value, at least to you. And if you had a non-fungible token that allowed you to prove that signature was given to you, and only to you for that specific copy of the book, then your cousin would still have a photocopy of the book, but they wouldn't have the non-fungible token to prove their ownership. So does it matter? Does it not? Well, that's a subjective question, and it's a subjective question that we answer by looking at how markets value these things. And so far, the answer seems to be, it matters. And we can find lots of people who will dismiss this as silliness and empty and a worthless gesture. And I think that in some cases it matters, and in some cases it doesn't. And we're going to have to figure these things out, because these things have never been done before. Let's wrap up with stablecoins. Matthew asks, first, thank you for this course. My question is, what is the safest in quotes, stablecoin for storing value? We know that Bitcoin seems to be the best cryptocurrency for that. What about the best stablecoin? I'm not looking for financial advice. I'm looking to have an answer on the technical aspect of storing value. Let's say I owned Bitcoin for a while and I made profit with it. I see a big bear market come in and I want to swap it into a stablecoin to preserve the long-term or medium-term value. Which stablecoin would be the technically safest haven? Thanks. So Matthew, what you're asking is a very common question. In fact, people are finding stablecoins to be a very good way to do exactly what you described, which is to park value into a cash equivalent in a national currency, pegged to a national currency, when they see volatility in the crypto markets. Now, I'm not going to tell you whether that's a good idea or a bad idea, but let's look at the technical analysis of risk. I don't think it's possible to say which is the safest stablecoin, because it depends on the threats that you face in your particular circumstances, the amounts that you want to invest, and the choices that you have available to you. However, what I can do is I can give you a comparison of the various types of risks. Okay, let's start with the simplest answer, which is to talk about not a stablecoin, but a national currency itself. So what are the risks of national currencies? What if I take my Bitcoin and I cash out into US dollars? Great. Where do I put the US dollars? Well, at first I might have them on an exchange. Now, that may be insured deposit. In the US, we have the Federal Deposit Insurance Corporation, which is not federal and not insurance, but it very much is a corporation. And that may or may not really protect me, and it's limited to certain amounts. And they have those in other countries, and those have not always worked. In fact, if there's systemic risk, they don't work. But let's say it does work, so you have it in the exchange. There are other risks, of course, custodial risks. The custodian can steal your money. They can freeze your money, perhaps on their own whim, because they think you violated a policy or regulation or terms and conditions that they privately determined, or they can seize it on government order because some government agency told them that for whatever reason they should take away your money. So these are counterparty risks, classic counterparty risks that exist with fiat. And you have these same risks if you put your money in a bank. What if you withdraw it and put it under your mattress? Well, now it can be stolen. So now you have all of the custody risk of keeping it secure. And also, as we saw in November of, I think it was 2018 in India, the government may decide to invalidate that particular currency unit in a process called demonetization. So there's that risk too, which is basically government default on its recognition of bearer assets. Now let's look at stablecoins. Well, there are probably two categories of stablecoins. There are centralized stablecoins and decentralized stablecoins. Centralized stablecoins have a custodian that issues the stablecoins, and presumably that custodian has some asset in reserve in order to back their value. So let's say, for example, Tether or USD coin or USDT or USDC and all of these other variants. There's probably more than 20 different stablecoins in different national currencies, pegged to different national currencies. Most of them are dollars, but there are some others too. And most of these basically come with the idea, with some amount of proof or not, that there are some bank accounts somewhere that have some dollars or other things of value in them that back these, and that there is a one-to-one correspondence between the amount of currency that is issued in these stablecoins and the currency that is stored in these bank accounts. Well, now let's look at the risks. First of all, you still have the counterparty risks with the banks, meaning that if the bank accounts of these stablecoin issuers get seized or frozen or stolen, or the bank collapses, that's an even more concentrated version of the risks that you face with your dollars in your bank account, because usually the amounts are not going to be covered by depositor insurance. We're talking about billions of dollars, not hundreds of dollars or thousands of dollars. So who's going to bail them out? And if the money disappears from the back end, how can you maintain the stablecoin? You can't. Of course, the government may seize them for a variety of reasons. So that's another big risk. That's on the back end. Then you've got the custodian themselves. Do you trust that when they say they have these reserves, they actually have them? So you have a couple of problems there. One problem is they might not have the reserves that they say they have. You can fix that with a partial audit where you see a proof of reserve. That's not enough though. If I have $1 billion in the bank, that doesn't mean that my balance sheet is a net $1 billion and therefore I can issue $1 billion of stablecoin against it. Because I, being a crafty embezzler and crook, may have decided in the back end to say, hey, I'm going to take that $1 billion and I'm going to go to another bank or even the same bank, and I'm going to ask them to give me a real estate loan for $2 billion against those assets. Now basically those assets are backing my stablecoin, but they're also backing this other investment, and if that investment goes bankrupt, there goes my collateral. So basically, in order to do an audit of reserves, you have to look not just at the assets that they say they store, but you have to confirm they don't have liabilities that you don't know about. That kind of audit is much more difficult to do, a full audit of their balance sheet. And very few companies actually do that. Now, some of the companies that issue stablecoins do so in regulated environments where they have stablecoins that are heavily regulated. Now you have another problem. Because these stablecoins are heavily regulated, now they impose various KYC AML rules that allow them, in fact require them, to seize and freeze and stop transactions unless they know all of the counterparties. Which means now you have a big fungibility problem. And you also have the risk that the stablecoin, since they're on a blockchain and are a digital asset, can be stolen from the exchange or from you by a hacker. So you have all of the risks you had for cash and bank deposits, plus new risks related to regulated money institutions that are not really that equipped to fulfill these regulations. A lot of these are smaller companies. They don't have massive compliance and security departments. And you additionally have the blockchain risks. So that's centralized stablecoins. And then finally, you have decentralized stablecoins. Now, decentralized stablecoins do offer a very different set of risks. You got rid of all of the custodial risks. You have stablecoins like DAI from MakerDAO, which are pegged to the US dollar, but which are operated by smart contracts that collateralize them with cryptocurrency, Ether, Bitcoin, etc. Now, these do not have the third-party or counterparty risk of seizure and freezing from banks. They do not have the risk of confiscation or systemic collapse of the banking system. They do not have the risk of under-collateralization because the contracts can be audited and the reserves can be audited. They're publicly auditable on the blockchain. This is a huge advantage because it fulfills the primary goals of decentralization, and it gives you stable coins that allow you to get the benefits of blockchains and get rid of the disadvantages of the centralized traditional banking system. However, they do introduce other risks. They do not only remove risks, they introduce some risks, and these are platform and contract risks. So contract risks, you need to be sure that the underlying smart contracts are well implemented. If there is a bug in the smart contracts, you might find yourself in a situation where you lose money. So that's one risk. The other risk that you have is platform risks. If there are bugs in Ethereum, or more bugs in Ethereum, I should say, or if the underlying platform currency, Ether, has problems with, for example, volatile gas fees, then you have problems with the stability of the stablecoin. And we've seen that actually in March of 2020, when there was a rapid collapse of the price of all cryptocurrencies by about 50%, and at the same time there was a spike in the volatility of fees, and the DAI system basically liquidated about $15 million worth of smart contracts that had collateral for stablecoins. This caused people to lose money. They became under-collateralized, and the normal recourse they would have in this case, which would be to fund their collateral, to basically top up their collateral, wasn't available to them because the fees didn't allow them to make the transactions on time. So, decentralized stablecoins basically also have risks. Arguably, and I think many people would argue this, they have fewer risks than custodial stablecoins or centralized stablecoins, and they have different risks, which are risks that relate to cryptocurrencies, which you might be much more comfortable with. I am. I think decentralized stablecoins are a much more powerful mechanism, and I generally stay away and I avoid centralized and custodial stablecoins because I don't trust the auditing mechanisms, honestly, and I don't trust the counterparties. So I can't be sure that the reserves are actually there. But again, your needs may vary. So that's an analysis of the risk of the stablecoin markets by category. I hope that was useful to answer your question from a technical perspective. And with that, week 7 is done. And this was my last week teaching this course, the 15th semester of the massive open online course for the University of Nicosia's master's degree in digital currencies. It's been an absolute pleasure teaching this semester with you, and thank you so much for attending my lectures, for reading the content, and for giving me fantastic questions and great interaction on the chat. so that we can have this great learning opportunity. It is a total pleasure. I hope you learned some useful things, and I hope you continue your studies and take the exam and graduate for the 15th iteration of this MOOC. Thank you all. I'm Andreas, I'm Antonopoulos, and I will see you next semester. Bye-bye, everyone.